Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. Today, I'm going to be analyzing Abbvie stock, and I'm going to be analyzing it from the perspective of a dividend investor, or from a dividend perspective, or using the dividend to value the stock. I don't do this too often because I'm not primarily a dividend investor. But I think there are stocks where the dividend can tell you a lot about the valuation, especially when some of the other metrics either fluctuate a lot or aren't perfectly clear. The dividend can serve as kind of a guidepost, especially if you imagine yourself from the perspective of like a dividend investor. So that's what I'm going to do with Abbvie. If you have a request that you'd like me to analyze and it's a stock in the S&P 500, just put that down in the comments section and I'll get it on my list, and eventually I will get to it. I somewhat go in order of the requests that I get, but sometimes people request more than one, and then sometimes I think some analyses are more timely than others depending on what's going on in the market. So sometimes I'll bump those up to the top, or I'll just look at it in the morning and I'll say, okay, this is one that probably needs to be covered now. If you have a stock that's not in the S&P 500, I analyze those over on Patreon, which is $5 a month. And then if you join there, you get a big discount if you decide to join the full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description. As always, this is not individual investing advice. I'm just sharing how I analyze stocks. And I'm probably going to be doing more of these dividend style analyses because, one, there's a lot of dividend investors, and two, some of the prices on these dividend stocks are coming down now. So it actually kind of makes sense to look at them because they've really been expensive. Most of them still are expensive, but I think now that bond price yields are going up, over the next few years, you're going to see these dividend stocks probably come down or stagnate, and that could make them more attractive. And I do have a method of using dividends to evaluate them, which is what I'm going to share today. So, Abbvie. So the first thing I always like to do is check the earnings cyclicality. Abbvie doesn't have that long of a history in terms of public data. I might be remembering this wrong because I haven't really looked at this stock too much, but I want to say they were a spinoff of Abbott Labs or a split of some kind. I could be wrong about that, but if I remember right, that's what it was. I mean, it was like 11 years ago, so I might not be. And I haven't owned either one of them before, so I'm not super familiar personally with them. But that's why we don't have data. It's not necessarily like an IPO, but we haven't really seen how it's done as an individual company during a recession, like a real recession, not the very quick one that we had from COVID. So it's just a good thing to keep in mind that we don't really know how the stock will respond or how earnings will respond during a recession because we haven't had one. Now, right now, earnings are declining, and we don't know where that decline will end. Analysts think it's going to end next year, but we'll see. But I'm going to go ahead and analyze this one using the dividend because I really feel like this is a dividend stock. Basically, you have a pretty high dividend yield. It's probably double the S&P 500 or something. And I'm pretty sure a lot of dividend investors are going to be looking to maybe invest in this one. So, and I think since we don't know much about earnings, while we don't know much about the dividend, if a business is known as a dividend, if their investor base are mostly dividend investors and they know that, then they're going to usually try not to cut their dividend and try to raise their dividend as much as they feel comfortable. And so you can use that as a kind of guidepost for what these guys are actually earning, because there's a lot of, so if we look at the difference between their adjusted earnings and their basic earnings, I mean, it's a pretty big difference, right? So we could look at this trough here, which it was $11 on adjusted earnings, but only $4 on basic earnings. If we look at the peak, we're $6.65 on basic earnings. We're at double that again. So these are big differences between the two. And so as an investor, you kind of wonder, well, what's really like going on? I like to have pretty quick ways that I can do this because I look at a lot of stocks, and so I need to make decisions, at least my initial decisions on whether to follow them, when to do more work on the business. I need to have those systems be pretty fast rather than reading through like a bunch of 10Ks and financial reports and trying to figure out a bunch of stuff I'm probably not going to be able to figure out anyway. So I think the dividend is actually a pretty good proxy for this one, given just the framework and the setup of everything. I do track this one on a basic earnings basis in my actual earnings based spreadsheet, and I think it's about 40% away from a potential buy using that method, and that one's pretty going to fluctuate a lot. I think I don't have a lot of confidence. Kind of given what we don't know about the earnings, that we don't have a recession or an actual recession. So there's a lot we don't know about it. And so I've never really dug too much into it because it just hasn't looked too attractive to me. But I'm sure it's attractive to dividend investors, and I'm sure that's why I got asked about it. So what we're going to do here today is we're going to look at what I call the dividend time until payback. And this is a valuation method to value a dividend stock based on the amount of time it would take you to earn your initial investment back via only the dividends. So you buy a business for $100. How long will it take you to earn $100 in dividends back? That's how it works. It's pretty simple, really. I mean, but there are some factors that you have to kind of make some judgments on. So I'll take you through that. Now, a lot of people don't understand that dividends come out of earnings. They aren't in addition to earnings. So I've had so many conversations where people just don't quite understand that. So in theory, over the long term, your dividend growth rate is going to be limited by your earnings growth rate. So if earnings are only growing 10%, and the dividend's growing 20%, at some point the dividend's going to get to a point where it exceeds earnings, which unless they borrow money or bring in capital some other way, then the dividend can't grow at 20% forever. Now, if the earnings are growing at 10% and the dividends are growing at 9%, that in theory, that could go on forever, right? And in order to earn your money back via a dividend, it takes a long time usually, especially in today's interest rate environment. So projecting out this long period of time actually kind of makes sense because unless it's a big dividend, it's going to take you a long time to earn your money back. So the way I do this is this number right here is is the dividend growth rate. I did this one last year from Fast Graphs. It looks like it's growing about the same or didn't change too much in the last few months, so I just kind of kept it in here. So they've been growing the dividend at about 14 or 15%, but when I calculated the earnings growth rate this time around, it only came in at like 7.62, but I do want to talk about that pretty real quick. So I used the adjusted earnings, which are more generous to them than the basic earnings. But here's what I did. I chose a time frame. This was a pretty big growth year, even though this one was kind of small. They probably balance each other out if I started the time frame in 2015. But I started it in 2016, and then this 2018 year was a big tax cut year, which is, I think, it probably explains why there was so much growth, more growth than normal. So I just excluded this whole year, just like it didn't exist. And then I took the earnings growth rate from year to year, from here to here, here to here, here to here, here to here, and then this down year. And then I also extended it out 1 year to 2024, what we expect here, because it's expected to be flat, basically. So when I put all that together, that's how I got my 7% approximate earnings growth rate. It's basically 2016 through 2024 without 2018. Fast Graphs is a little higher at 11%. Probably because, well, they definitely include this one. And they aren't including this extra year, which is expected to be flat. So that's where the earnings growth rate came from. They didn't have a ton of buybacks, so that didn't really work into it much. But we can see that, and we can probably, I haven't looked at this in a while, but maybe I can find the dividend stuff in here. I don't know if I can or not. I haven't done it for a while. I pull the dividend stuff from FastGraphs, but I don't usually look at the dividends. But they're in there if you want to look that up. It's not going to make any difference, actually, because I know the dividends have been growing faster than earnings. So the way I do this, growing faster than earnings, yeah, that's right. So the way that I do this is based on the payout ratio. If the payout ratio is over 50%, then I take the more conservative of the two, which is the earnings growth rate, because eventually they can pay out more. They can pay out increasing dividend growth more than earnings growth until this gets up closer to like 100% or 80 or 90%. So there is some space where they can grow dividends faster than earnings, but since we're projecting out 10 to 20 years in some of these cases, they're probably not going to be able to raise the dividend at this rate for like 10 or 15 years unless earnings growth picks up. So we can go down here and see. So this is all the earnings have grown from here to here. Not very much. But the payout ratio went up because the earnings came down. So this is what I'm going to assume the dividend growth rate will be at. And we start with today's yield, which is about 4.33%, and then we grow that at 7.62% per year. So after 5 years on a $100 investment, you would have collected $27. After 6 years, $33. Okay. And what I want to know is how many years it would take me to cross that $100 threshold, which will be 200 here because the first 100 is your initial investment. And that happens in year 14. Okay. If dividends grow at about 7.62%. So this is the time until payback. It's going to take you 14 years to earn your initial investment back via the dividends, given the assumptions that we have here. My threshold for a dividend, purely dividend stock, is 10-year time until payback. So that would be about $90 per share. Right now we're at 137, looks like. So we're looking like 40% lower, probably 40, maybe 45% lower before I would consider it like a dividend buy. This range would be in the very expensive hold range. It depends on how you think about it. Like for me, 20 years is clearly a sell from a dividend perspective. If it takes 20 years to earn your money back from the dividend, 15 is where probably I would start thinking about it. I mean, it just depends. It's kind of a personal choice. I would say anything but below 15 is kind of, it's not cheap enough to buy where you're getting a good deal, but it's also not very clearly expensive. The other thing I would point out is a 60-40 portfolio, which is usually what I compare a dividend growth stock to. That actually would take 20 years. So 60-40 is still a sell. And the yield for the Abbvie stock is still pretty attractive, like relative to what you're going to get with like a 60-40. So I would probably rate this one a hold, even though from a dividend perspective, maybe if somebody already still owned it, collecting a 4% dividend, growing at 8%, assuming that there's some inflation adjustment there. So far, the revenue trend looks okay still for Abbvie, so it doesn't look like it's in danger of cutting the dividend anytime soon. So yeah, this would get like a hold rating from me. And even there aren't a lot of other dividend stocks that are much cheaper either. So, but I wouldn't buy it. I wouldn't buy it until it was $90. Okay, so those are my thoughts. I don't do too many dividend analysis. It's been a while, but this is how I think about it and kind of how I would approach it if I was really just looking at the income part, the income and income growth part as Abbvie stock as an investment. If you found this useful, hit the subscribe button. If you have any requests yourself, drop them in the comment section. I'll see everybody later.